Great. Well, thank you for inviting me to this presentation. I'm Leslie Jouflas, and my website is Trading Live Online. And I was really excited to see the topic of the psychology, discipline, and time management in trading. But these are super important topics. I think they're the most important topics because what you've got to master in trading is yourself. And that's a long process. You can do well in trading as you go, but you're going to constantly be learning new things about yourself with your trading. So I always call it blending your method with your mindset. Now, I've been in the markets for about 25 years now and counting. I'm a CMT, and I've had a long history of studying a lot of different methods. I primarily use what's called pattern recognition setup, and I'm going to show you just a little bit of that. It ties into the presentation today. I did a presentation in March for the Synergy Trader event. So if you want to look that up, you'll learn more about that, these setups. I've got a couple of books out, Trade What You See, How to Profit from Pattern Recognition, and that's a comprehensive book on this type of trading style. And there's another book, Essentials of Trading. It's not what you think, it's how you think. Unfortunately, that is not in publication anymore. It went out of publication when I think it was PFG was a futures firm, and they had some issues with some of the government regulators, and they had actually purchased the publishing company that had originally published that book. So when that whole firm went out, we lost the publication with that. But you can also find me along with being on these presentations. You can find me on my website. I've got a blog there. I do regular segments for stockcharts.com and lots of other things. If you'd like to be on my email list, just hop over to my website and sign up for the email. If you have any questions or just any comments, there's my email address right there on the screen. And I'm always happy to reply to emails. Okay, well, let's get going because we have a kind of a limited amount of time and I want to cover as much as possible with this. The next presentation is going to be on futures, and I'm going to be presenting the S&P 500 E-mini futures trading with this type of pattern recognition. Okay, and there's that little disclaimer. I think you've all seen that. This, of course, is intended for educational purposes only. So preparation for trading. This quote here was taken out of a book that I have written by W.D. Gann in 1923. And if we look at this statement on here, this could have been written yesterday, or it could have been written this morning. I have a lot of books from the 1900s, 1940s, 1950s, and a lot of contemporary books too on trading. But I really love the old classics. And I don't think there's one of them that does not start their books without something like this. And he's talking about how people come into the markets just thinking it's going to be a simple thing to jump in and just start making money. And they really have no preparation for it. They have not made any study for it, and then sort of wonder why they're losing money. Maybe they get into a market that, you know, as we have had previously, that was just sort of a straight up market and it looked like it was really easy. But I'm hearing now from a lot of people that their retirement plans have been affected. They can't retire when they wanted to. So there's the flip side of it, but no experience. So just study this, and you can take a screenshot if you like. This will be recorded, you'll get the recording, but I think it's a good thing to have, even print out and keep on your trading desk. So as a trader, your emotions are playing a big role in your trading, and you have to have a way to know how much your emotions are costing you, not only because it's very taxing to have your emotions in an unbalanced state, but it's costing you money as well in your trading. There's different types of things that you've got to be aware of that can trigger different emotions. What types of market environments? Is it currently? Are you trading? Are you experiencing fear or euphoria? Are you paralyzed in your trades? But your trading plan, this is the key to understanding and working with your emotions. I'm not a believer that emotions disappear or there's any secret method or secret sauce to getting emotions to just disappear. We're human. So I think a better approach is to learn to understand what emotions, and there's usually more than one, how those are getting into our trading like little gremlins and affecting the results. I think this is a more important way to look at it. And I'm also not a big fan of the word discipline in trading because I think discipline really refers to something that's very like solid, that you have to follow this exact, path. It's rigid. And I think we have to have a lot of flexibility. So again, I think this brings it back to more the concept of understanding the emotions, the good and the bad emotions that are active in trading. They're just as active as anything else in trading. Now, the emotions are always going to be something that are going to help us or hinder us. So we want to tip that over into the helping side. One thing I'm going to talk about during this presentation also is random trading. And random trading is going to trigger unwanted emotions. And so you really have to be aware of that and how much that's costing you in your bottom line. And I'll bet that probably most of you can't give me a dollar amount of how much those emotions are costing you. I do have a way, I do have a method when I work with traders that we look at this and we uncover this and we can get it down to the penny. So do you know if you're staying on the course of your own trading plan? And if you don't have a trading plan, of course, the answer is going to be no. And do you know how much risk you should be taking, how much, or markets or time frames? There's a lot of things to consider. Another important is how do you recover from drawdowns? Now, emotions can be high when there's drawdowns. So you have to learn really how to know what emotions are going to be really trying to steer the boat for you. You don't want them to, but that's a very important time to understand your emotions if you want to learn how to come out of drawdowns. So a lot of traders, what they tend to do instead of learning these steps and a process is they just jump from one thing to another. Here's the newest, this looks easier over here. Oh gosh, I feel terrible. I just lost money on this. Oh, this doesn't work. Well, unless you've tested it, you really don't know if it works or not. If your approach is random, it's not a fair statement to say something doesn't work because you have not taken the proper steps to do any testing with it. A lot of traders also, stuck glued to CNBC. That's probably not going to be your best bet for making money, or just, there's nothing wrong with being in groups of other traders and, having good support groups. But if your goal is to only follow somebody else's trades, you have very little chance of success in this business. You've got to learn to fish for yourself. So again, do with all of that, when your emotions are tilting to the fear, the greed, the euphoria, paralyzed. So what do you do? Well, you've got to have a trade plan. So if you have a good mentor, and you've got to find someone that really resonates with you. It might be me, it might be somebody else here, but you've got to just really love what they're doing and what they're saying, and then go with that. Okay, now I put together just a little slide here of a list of important reasons why traders, I think, are succeeding or failing or just struggling. I've worked with a lot of traders that have struggled for a lot of years. I call it the hamster wheel. They kind of make money, they lose money, they lose money, make a little, lose some more, maybe make a larger sum, give it back. It's a hamster wheel. It goes around and around and around. Well, there's some, there's something that they're not following in a process to be able to determine what's keeping them in that on that hamster wheel. And just like we looked at that slide from W.D. Gann from 1923, few traders are willing to learn and follow a process. And I find that really interesting because that's the path. That is the path that is going to get you to consistency and success in this industry and longevity. So you have to kind of maybe put the internet, all those 100 YouTube videos on how to trade, maybe turn off some of the noise, and just try and find a specific direction and then commit to it, and that's probably going to help you quite a bit. So this, when I thought was putting together this presentation, I thought, wow, I could do a whole day easily on this. So I'm going to try and keep it to the things I think are most important. If anybody wants a free 30-minute consultation, wants to talk about some of this, just email me and ask me, and I'll get it set up for you. And, if it's not with me, I can help you find a direction with it. Okay, so plan your trades, trade your plan. Right under that, there's a quote that I have on a t-shirt from the Chicago Mercantile Exchange when I visited there one time. And the t-shirt says, where there's no such thing as no such thing. I think a lot of traders also have somewhere in their mind that nothing bad's really going to happen to them. They don't believe they can lose a lot of money. Well, sometimes losing a lot of money has nothing to do with you. Maybe you are a very skilled trader and you do have a process and you've got a tested trading plan, and you have no difficulties executing that trading plan, but there could be an outlier event that happens that can cause a large loss. So hopefully those things are factored in, from the risk standpoint in your trading. So anything can happen. So we always want to use stop losses. Random trading, as I say, is just poison to your results. And random trading also triggers the mental errors. And if you don't have a way to track that in your process, then sort of looking for something that's going to tell us, oh, what's it going to do? Where's it going to go? It's never going to happen. We never know how that right side of that chart is going to get filled out. We can deal with probabilities, but we can't deal with certainties. So we have to, that's an emotional state that makes us want to really know, and it can cause anxiousness, it can cause frustration, it can cause fear, it can cause anger, trying to figure out what price is going to do. So that might be something you might want to take into consideration and kind of think about if you're susceptible. So again, the trade plans they're essential to that path that you want to be on. And they do take time. There's not a quick way to do it, to develop and to test. But the testing doesn't have to be a difficult process, but the testing has to be able to let you know if what you are doing has a chance of being successful if you implement that on a trading plan basis. And also to find out if that particular trading plan, if you have issues executing it, then there's something emotional going on, and maybe some changes need to be made to blend that method and that mindset. So a trading plan is going to be unique to each trader. There's not a cookie cutter trading plan that anybody can just give you and say, here, this works. It might work really well, but it might not work with you really well. So just remember, you've got to be out there trying to develop your own trading plan and your own path. So when you're developing that, there's a lot of different skill levels, and I'm going to show you some that go into trading. A lot of traders get into trades really easily, but they don't know where to get out. Well, getting into a plane is easy, but jumping out of it is a little bit different story too. So, you might want to think about that with your trading. Another thing is, so what market conditions are you trading in, and how much do you know about identifying shifts in market conditions, from trending conditions to ranging, from ranging back to trending? And does your trading plan dictate if you're in the markets or out at any particular time? And so you've got to maybe just start with a blank sheet and write down some of the skills that you need to start developing. And I'll show you one of the slides in a few minutes that might help you with that. Routines are very, very important. I think routines are one of our best tools for helping us as individual traders get back into balance. We've always got to stay in a balance. If remember the seesaws when you were a kid, and you get one kid that just jumps onto the end of it and you go flying up. Well, you want to keep that as balanced as possible in your trading and be able to know and understand when it's starting to get tilted off balance. And having a regular routine can be something that can bring you back to that center. Traders often experience frustration, and that comes from not meeting expectations. It's just that simple. If you're truly a believer that, anything can happen, price can do anything it wants, not one trade is ever important. It's a matter of looking at series of trades, not just one. If you believe these things, you don't know what's going to happen, then the frustration will just it'll fall off. It won't be something that you need to deal with. And how you handle, of course, losses and errors. I think this is really important. It's easy to handle wins. I mean, if anybody out there has a problem handling wins, just raise your hand. But it's learning how to handle losses and our errors and in our drawdowns. And that's got to be in our trading plan. So here's a few examples and a quote from Mark Douglas. He is the author of Trading the Zone. He very unfortunately passed away much too soon, several years ago. But he says all traders give themselves exactly what they feel they deserve. Trading is an exercise in accumulating money. And once we've learned how to trade, perceive opportunity, and execute our trades, who else or what else could be responsible for how much we end up within our equity account? So that it's to the point, it's exactly true and right on. So we have nobody else to blame but ourselves. So again, feel free to take some screenshots of these things. It's okay with me. So he had some examples in Trading the Zone of trading errors that are pretty common with all traders. You hesitate, get in late. So, what emotion would we put with that? You're fearful. You have a fear of losing money. And that's what causes that. You jump the gun and get in too soon. You're afraid of missing out. You define your risk, but you don't take your loss. Maybe you cancel a stop loss order because you just don't want to take a loss, or you don't believe the price is going to get there, or you believe it's going to turn around and the loss turns into a bigger loss. And this is how, this can be an extremely dangerous thing. So that's a overconfidence in your trading. And you don't define your risk in advance of the trade being initiated. if stupid is an emotion, then that's what that is. Get out of a winning trade too soon. Again, that's fear-based. And let a winning trade turn into a losing trade without having taken any profits. Well, this is dependent on the trading plan and how a trader is managing a tested trading plan. Sometimes a trade will go under profit, and then it will, because it's not time for the stop loss to be moved. So it goes back, it takes the stop loss out. That's an acceptable loss. But if you do something like you move your stop loss further, or you just completely, cancel your stop loss and let that trade turn into a losing trade, that's a mental error. Here's a big one: move a stop loss closer to your entry point, then get stopped out. So moving a stop too close too soon, likely the trader has not tested their stop loss to know what size stop loss they should be using. A lot of traders place their stop loss based on the fear of how much money they don't want to lose, rather than the correct stop loss for what they are trading. Robert Miner, he's like a genius whiz in Elliott Wave, and the beginning of his fantastic book on learning Elliott Wave. All successful traders have a defined written trading plan, and he goes on to say it can be many forms. I believe in simple trading plans. Trader that doesn't abide by is doomed to failure. So we kind of, sort of the same things Gann was saying in 1923. This is important. Each guideline and rule must be included with reason and purpose. So that means, like, for instance, an example is, like maybe indicators. Sometimes traders will have, let's say, 10 indicators on a chart. But if you ask them, well, how does this indicator help you make more money or lose less money? If you're not able to answer that, then you really shouldn't have that indicator on there. And you should study that indicator and only use it when you can answer that question. I really like method of technical ones that are vital and need to be in there. And unfortunately, you sort of learn it backwards. So traders come in, they throw some money into an account, they start throwing out, spaghetti at walls. Maybe this stuck, maybe this didn't. And none of these are being addressed, especially the mindset skills. And I think right now in this market environment, my guess is that a lot of traders and investors are right now learning the very hard way what losses, a lot of people are losing some money, not everybody, but a lot of people are losing big money, especially the tech heavy stocks that a lot of people were into very, very, very heavily, and not skilled or experienced enough to know how to handle that. So let's just go through a few things on this list. Method, your approach. What type of method are you using? Focus is important here to find a method or particular types of setups. I think you should focus down to one setup and learn to be a master of that and learn all the skills with that setup. And then you from there can decide if you want to branch that out and to be focusing in one market and pretty much one time frame, although you can be learning to combine time frames, but pretty much trading off of one time frame until you get really good at it. And some traders, you're going to be a technical trader or just fundamental. Maybe you're going to combine both of these. But if you do that, how are you going to do that? You discretionary or mechanical? I'm a discretionary trader, but my things that I trade are tested, but I don't implement them on a mechanical basis. I'm the mechanical basis for my system. And technical analysis skills. Now, I'm a CMT, and before I went through the CMT exams, I had already had, gosh, I don't know, 15, 16 years of being in the market, studying a lot of technical analysis, knowing a lot of technical analysis, applying a lot of technical analysis. But I went through, I really wanted to have that designation for my own, just for my own accomplishment. And I learned a lot of really neat things and picked up a couple of little kind of pearls in the oyster that I added into my trading. But technical analysis is a skill in and of itself. That is an art, it's an art and a science at the same time. It takes a lot of experience to get really good with it. Again, developing routines, knowing your market environments is very important. And all of these take mindset skills. So, markets trader, time frames. Sometimes a time frame, you're on the wrong time frame if you're losing money. Sometimes it can be as simple as that, but I think you need someone to help you with that, to help you determine if that's might be something that's causing you problems. Of course, developing your trading plans and testing a trading plan. Trading plans just don't grow on trees. They've got to be developed so that you can trade it and execute it at, a high percentage. And your risk management is super important. And again, all of these things, again, are related to our mindset skills. So they have to be designed, and we have to be able to operate these so that we're not tilting our mindset into the zones we don't want it to go. Because remember, your emotions don't go away in trading, but we can certainly learn how to use them as assets. I think of the emotions in trading as sort of like the seven dwarves. And you've got grumpy, and you've got, who's the other guy, the guy that was really mad all the time. And anyway, there are a lot of different emotions that are layered because we're human, and they can all be there in our trading. So, I guess I kind of duplicated that over here. Sorry about that. Anyway, okay, so you get the idea that there is just a lot of different skills that go into trading. Now I'm going to show you just a little bit. So I'm going to show you a couple charts with a couple setups and talk about the emotions that traders might be feeling on different types of setups. I'm going to walk you through very briefly, just a simple A, B, C, D type pattern. This is what I use in trading. I use different classic patterns, but this is probably a staple. So A, B, C, D is basically two swings, A, B, and C, D, that are about equal in length. There can be an extension of that swing, and they're separated by a retracement leg, which is the B to C leg. Fibonacci retracements are helpful to determine that retracement, and also to know when that retracement has gone too far or not far enough. Generally, a minimum to the 382 retracement, and not beyond where the A point started. So the lightning bolt is going up with a sell pattern, and this lightning bolt shape is coming down with a buy pattern. Okay, so let's keep that in mind, and we'll look at the next chart, which is a sell setup. So this is a sell setup in American Express, A, B, C, and this D extended beyond this last swing. So that just makes it what's called a butterfly pattern, which is a reversal pattern. Now, here's what I'd like you to think about with this. Let's look at how that C to D leg formed. look at how all these up bars in it. Now here, everybody's thinking, oh, look at this, American Express is going up forever. But here's this pattern that I know. This is what I mean about your technical analysis skills. This may not be a pattern that you see when you look at a chart, but I see this pattern. And so if this pattern is forms with the structure that is part of my trading plan, I'm obligated to take this. And so that means as this is roaring up to the upside, and everybody couldn't be happier about it, I've got to get in there and sell it short. And so that emotionally, for a lot of traders, can be a point where fear is going to paralyze taking the right action. So you've got to always be doing the right thing, because we don't know what that right side is going to do. So when it gets up to here and you have to sell it, you don't, of course, didn't know it's going to do this. It could do this, keep going, but you have a stop loss to protect the trade. But there'll be emotions here. And in those types of points, that's where you have to really understand what's happening with your own psychological makeup so that you can get past missing your own trade setups that you're obligated to be in according to your trading plan. So the way that you do that is, first of all, you have to have a trading plan. You have to be aware of when these emotions are kind of triggering and making you do things that are outside of your trading plan. Have a way to track that. Now, with time and practice, that's going to become smoother for you. And then, your mental outlook on it is probably going to shift to one of fear and see it as one of opportunity, because you'll miss enough of them that do this that's going to cause frustration, because maybe even a little bit of anger because you weren't in it and you were supposed to be in it. So I hope you kind of are getting the point on that. So the easiest way to get there is to learn to do the right thing at the right time, and only your trading plan is going to be able to help you dictate that. Now here's another example. This is an S&P. This is the intraday chart showing some ABCD patterns, both sell patterns, buy pattern, sell pattern, buy pattern. Now here, and I'm going to show you another example in just a few minutes of taking one setup and hypothetical examples of what maybe 4 different traders might do with the same pattern. So here, this is a sell pattern here, and you can see that the price got up to where the lengths were equal, and it got a retracement here to the downside, probably about 50, close to a 50% retracement of this leg here. Now, sometimes without a trade plan, what happens is traders think, might get a belief that, oh, this is turned down, it's going to keep going and going and going and going and going. They have no plan for an exit. Remember, jumping out of the plane. And maybe they don't even have a stop loss. But they're stuck in this belief. And so they can't believe when this starts to happen here, it totally turns the other way. But a skilled trader who's developed a trade plan and understands what the reactions of this type of a setup or any setup might do, the outcomes, they very well may have taken some profits, moved a stop loss down and had a profitable trade on it. Whereas another trader who's totally, open and unskilled with a trade plan and blending the mindset with it, probably got out right around here at a loss just before, it turned back to the downside. Same thing, this type of pattern here. This took a little bit of jiggling around before it had to move to the upside. How much jiggling around will your mindset at this point allow you to do? Mindsets are flexible and we can learn to expand them. They're not going to expand in a huge way immediately. It's a step-by-step process. but just be aware that you can expand them. So if right now, if one of the issues that you have is you get into whatever setup you use, or any, a trade that you just got into and you're expecting it to move to the upside, and you get in and it does some jiggle to the downside, are you becoming very fearful that you're going to lose money? And so it comes up and you think, oh, phew, okay, it's coming back up, and then it goes down. And now you're like, fearful again. So you get out right at the lows here, and then it turns and does this. If that's something that's common in your trading, then that's where you've got to be looking, and you have to have a trade plan. The trade plan should dictate whether you get jiggled out or you get to sit in the jiggles. It's not bad to sit in jiggles. Jiggles are not a bad thing. The market jiggles around all the time. So don't be afraid of the jiggles, but your trade plan and your stop loss are going to dictate whether you sit in with those jiggles or not. Okay, so there's just a few examples, and you can kind of imagine yourself some of these other scenarios that might happen to traders. Now, talking about trade plans, so patterns are just patterns. That's all they are. They're just a formation on a chart. They're formed by X amount of bars going up or going down. They could be triangles. They could be head and shoulders pattern. They can be ABCD patterns. Whatever they are, they're just patterns. So they have no value to them until you create the trade plan, which includes the trade management. And the trade management, that's the engine that fuels the patterns. That's how I like to think about it. So, I mean, I've had, people over the years say, oh, these patterns don't work. Oh, well, tell me your trade plan. Well, I don't really have a trade plan. I just sort of get in here and then I kind of think it's going here. Well, yeah, they probably don't work that well. And again, I'm going to show you an example in just a couple of minutes of, hypothetically 4 different traders. But a trader that has studied the setups that they use, and they know that setup like the back of their hand, they know that setup and every market condition that's, ever been around, they know what to expect. And they know what changes, alterations they might need to make in a trade plan with different market conditions, that they know if that the expectation is that setup is going to produce a profit over time. Again, it's not just one trade. We're looking at series of trades and time. So, okay, so our trade management, that's the engine that we need to, apply to the patterns. So there are many ways to trade the same trade setup. And that also has to do with each individual trader's, emotional makeup and maybe where they are at their skill level, and how many shares or contracts. A lot of traders that are trading too many shares, too many contracts, and they're feeling a lot of emotions. They may want to consider cutting back and seeing if those emotions come down. Planning, your entry point there. I use specific entry points in my trading that are sort of calculated, that I know over, thousands and thousands and thousands of setups, that's how to do the entry. And same with the stop losses. Again, don't place the stop loss because you don't want to lose, you're afraid to lose more money than this. The way you can track that is track those trades and see what would have happened without that trade. Let's say 10 trades or 20 trades. What would have happened with that same setup if I had not moved my stop loss, or if I had used a bigger stop loss? And start to observe and see what happens. And again, exits, plan out your exits, and then you've got to practice and make adjustments until it fits you, and apply some basic metrics to what you are doing. So again, no 2 traders are exactly alike. This is why it's difficult to follow trades from another trader. I mean, I used to operate my live trading room for several years, and it was educational. I mean, we put every single trade, everybody saw every single entry, exit, explained what, the trade management, lots of things about the market environment, but mostly traders could not follow each trade one right after another. They would randomly decide, no, I don't want to take that one. Oh no, I'm going to take this one. And so the results would vary greatly. It's because you're not going to be able to follow exactly what another person is doing. You can learn from them so that you can develop your own trade plan. If you like that style of trading or the types of setups that they use, you can eventually develop that for yourself. But I don't think there's a great chance of success just following another trader. You don't have the confidence to do that, and not understanding, completely the method. You're sort of, flying blind, so to speak, or sometimes it's just not revealed. It's sort of a black box, and you don't know what's in that black box. They're just telling you buy here, sell there. I think that's unnerving personally. So you want to just learn and stay with the process and build your confidence. Okay, so here is a slide showing the 4 outcomes of any given trade. Doesn't matter what method you're using or setup, pattern, etc. So you can have big wins, small losses, big losses. These are the things that can happen. So I have the number corresponding, which each one, number 1 is a big win, number 2, 3, 4. So over here on the top, the black line, so here's a 2. So we can see just a slightly upward moving equity line there. So there's a small win. And the small win is followed by a number 4. So that's followed by a big loss. And you can see the equity curve, having a steep decline with that. And then the next line down, we have this green line starts out with a number 4. It starts out with a big loss. And the number 1, it follows that with a big win. But that win's not big enough to overcome that big loss. And down here on this pink line, again, we have a big win, and that's followed by a small loss. You can see there's not much of a dip there. Another big win, another small loss, another big win. And here on the last one, the blue one, we have kind of a small win, and we have a small loss. Small win, small loss, small win, small loss, small win, small loss, which isn't bad. That's not bad, but every once in a while you've got to be finding some of these bigger wins to add into this type of an equity curve. So which one of these 4 things has to be removed? Oh, I can almost hear everybody. Big win. You're all yelling at me. Yes, that's absolutely right. Big win, or excuse me, big loss. So you've got to take out the big losses. So if you go back and look at your trading over maybe the last month or so, 2 months, and if you've tracked it in any way, and you did nothing, no other changes, but remove big losses, and see how that would have impacted your trading. Okay. Now I'm going to talk just a little bit more about random trades, and then we're going to go through this example, because I think random trades are probably one of the biggest evils in trading. And a lot of traders, I am pretty sure, are not even aware that they're doing a random trade. So what is a random trade? A random trade is simply any trade that's taken on an impulse. It's any trade that is done outside of a trading plan. So some of you might be saying, oh, well, I don't have a trading plan. Well, then all of your trading is 100% random. And again, there's very little chance of long-term success with that type of a trading. So these types of trades trigger some pretty big emotions, and they start with emotions. They're impulsive, and again, it might be the fear of missing out on something, or the trader's impatient and they don't wait for the correct entry. And the biggest thing with this is starting out with emotions like that, they can start to trigger those small emotions can grow into bigger uh, emotions, like revenge trading. That's when a trader, takes a loss, takes a loss, takes a loss, takes a loss, and their emotions are just going down the drain with each loss, and now they almost get to a panic state where they feel like they must get the money back, and they go into like a red zone emotionally, and they start just trading like crazy, trying to get the money back. And I have heard of traders that have blown out accounts in one day. I heard of a trader, this was a long time ago, kind of early in my career, where it was actually trading an account for somebody. It was somebody else's money, and he'd been doing fairly well with it, but then had a day that just didn't go well. By the end of that day, this trader had done dozens of random trades trying to get a loss back and was losing more and more and more. And he panicked and he went into the revenge trading state of mind, and he blew out that account. So that, these emotions, they're no joke. You really got to get a handle on what they are and how they're coming up in your trading. So they're poison. Random trades are poison, and along with the big losses, random trades need to be removed from trading. Okay, so our last slide, here's an example here. So this illustrates multiple ways to trade the same pattern. So over here we've got trader 1. So he's blue, trader 2 red, trader 3 is green. So here's that ABCD sell pattern I told you about. So this pattern completes. So trader 1 over here. So you can kind of think about which trader you might be. So trader 1 takes a small profit here. So here comes down to retracement, takes the profit, and they're out. And you see, well, why didn't they just stay in for this whole thing? Well, maybe that wasn't their trade plan. Let's assume trader 1 was following their trade plan. They had a particular either, dollar amount, number of points, or retracement level that was their exit strategy, and that's what they took. And that's it. They're out of the trade. They're not going to be concerned with what the market does after they're out of the trade. So we don't know if that was, if trader 1 was that's their plan or wasn't, but let's assume that it was. Now trader 2 here, you can see up here, trader 2 moved their stop loss too close too soon. And so the market, trader 2 gets in at the same point as trader 1 did, and the market starts to move down, and trader 2 moves the stop loss down and gets tagged out of it just before the move to the downside occurs. Now, again, do we know if trader 2 was following a trade plan? Did the market move X amount of dollars or points, and their trade plan dictated that the stop get moved down? Or were they afraid that they were going to lose either money or profit? It made them nervous, and so they moved their stop too close too soon and missed the down move. So that might be something that is occurring with you. So trader number 3 over here, you can see has multiple exits. And just to generally, trading ranges are usually better to have an exit strategy, just to do better with targets, and trends generally do better with trailing stops. So Trader 4 or Trader 3, took a partial exit here, moved a stop loss, took a second exit here. This is a very skilled trader to be able to do this type of trading. But an inexperienced trader might get lucky and do this, a couple of times, but they don't know what they're doing or how they did it. So is it a repeatable process? That would be the big question on this. But if you build up your skills and then you're able to execute some trades like this, and all of them are going to do this, then you're on the right path. Now, Trader 4 never got in the trade because they were too afraid to pull the trigger. So remember, we talked about that with that butterfly sell pattern example that I showed you, how much fear you might in the beginning before you really know what you're doing might feel. And so you don't get in the trade because you're afraid of losing money. If you're that afraid of losing money, the trading is probably not going to be for you. You can manage the risk, manage the losses. But if it's a recurring pattern and you just can't handle emotionally, it just might not be a good venue for you. So Trader 4 or fourth trader, they never got in. Okay, so that is the end of this presentation. I hope that you found some things to think about. And of course, feel free to email me. Here's my email again, if you'd like. The patterns that I use here, if you'd like to learn more about them, this is a 3.5-hour course. On the website is $99, but if you use this coupon code at checkout, go to Trading Live Online, go to the Introduction to Pattern Recognition course, and you can learn about the structures, the history of fib ratios, about harmonics. Harmonics and repetitive swings, they form all chart patterns. Every chart pattern that we know of is formed by harmonic and repetitive swings. So you might find that interesting. And then there's another pattern, 3 ways to use a three drive pattern, which is, I think, very interesting, and Fibonacci extensions. And then you can also have 1 month free subscription to my weekly market setups. And this is a video that's usually about 30 to 40 minutes long. I send it out either late in the week. It's our preparation for the coming week's trading. It might help you to build some routines. You'll learn a lot about technical analysis every week with this. So you'll get that as well. But the reason I did this course was because I want anybody who's interested in this to not have to spend a huge amount of money to find out if they really like it. So it's a nominal amount of money to learn a lot about these setups and to join me for the weekly market setups. And by that time, you will know, yes, I want to learn more, or no, this isn't for me, but thank you. There's some things I can take with me and find something else that works. And again, I'm always happy to try and help point you in a direction that's suitable for you. But if you do want to take the course, then once you open it up, these are all the sections, and the course will tell you how much you've completed of it. So your goal is to get to 100% on that. And then you also get a free copy download book of the Essentials of Trading book that's no longer published, but this is a book about mindset. It was meant as a compilation of articles and stories that I wrote with Larry Pesavento. We meant for this to be something that traders can turn to when they need some inspiration in trading. And so it's all kinds of different topics, and you can just, like, when you need it, just open it up and read a chapter or two. Each chapter is just a page or two long. And again, if anybody would like a free consultation, please just email me, and we'll find a day and a time that works for us. Well, thank you very much for joining me on this presentation. And again, I hope you find some things that help you in your trading journey.
All right, thanks, Leslie.
Thank you, David.
Great presentation.
Thank you.